No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning and welcome to the Retirement Report. I'm Hank Parrott, your host. We're going to be talking taxes this morning. This is one of those areas we're nearing the end of the year, so it's a good time to be thinking as far as planning. Are there any last minute things to do in this year before the year's up to help reduce your taxes for 2019 when filing time comes next year? In addition, it's a great time to be planning excuse me, time to be planning for what's going to happen next year, to kind of set things up, and if you will, and have your strategies already in place. And there are a number of strategies that are available to you when it comes to the new tax law. So understanding the new tax law now that this is, I think, our second year basically of using the higher deductibles and and no exemptions, and we're going to be talking about qualified charitable deductions and how you can use those to your advantage. We're going to talk about required minimum distributions as we're nearing year end. This is another area. If you've turned 70 and a half this year, you've got until the end of the year to get that taken care of. If you've inherited an IRA, this is also a time, if you inherited an IRA in 2018, then you have until the end of this year to take your required minimum distribution there. So a lot to cover, as well as strategies that have to do both pre-retirement and in retirement that you would need to know to be able to prepare if you're heading into retirement, some great tax strategies, and if you're in retirement, how important it is in particular to understand how the tax law works, how you can use it to your advantage to minimize your taxes, thus keeping more of your money, of course, in your pocket. And here to help me with that today is Dr. Friday with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. She is a tax expert for individuals and small business owners. And this is one of those areas. If you're a small business owner, as you know, payroll taxes, this is an area you can really get into trouble if you don't have, having to do that on your own, I think is really a bad idea. We have a business to run. We have enough taking up our time in running our business that taking care of taxes, in particular payroll taxes and the like, just way too time consuming, way too many reports that have to be filed and in a timely fashion. And it's the area that I think, small business owners, that's probably the area they most get in trouble with.
Yeah, and it's the most unforgiving that the IRS has with fiduciary taxes. So when you withhold someone's payroll taxes, the Social Security, Medicare, and you don't pay it, it is one of the harshest penalties, the largest audit areas, and as well as they give you a very small window to pay that money back. So it is something that you really, if you're making choices of who not to pay, and the IRS gets very upset when they find out you're still paying your rent and you're still paying your utilities and you're still issuing payroll checks but not paying the payroll taxes, that is not something that they want to see. And so they do have some pretty aggressive ways of either closing your business or down or putting liens, levies, and seizures against your bank and home and other properties.
One of the areas when we talk about taxes, and this is a report we touched on before on the show. We got into talking about the new tax law, strategies you can utilize, 20 questions every person, family, and business must answer soon. So one of those areas, we covered a lot, and I'm going to just briefly kind of bring you back up to date in this as we launch into charitable giving. But one of them was the tax deductions that you counted on in the past may have been eliminated. So one of the things that happened Friday is, of course, we had the new standard deduction. So
right.
Now, and in particular, since the show, of course, is leaning into the retirement piece. So if we're talking about a married couple pre-age 65, you've got $24,400 this year.
Right. And then obviously if they're over the age of 65, you have an additional, what, $1,300 each?
Yeah, so $1,300 each. So that gives, so basically for a married couple filing jointly, age 65 and up, you're looking at this year, $27,000 for your standard deduction.
Right.
So this is one of those areas for people that were, under the old tax law, were used to itemizing that this this creates a problem.
Well, you think about prior to that, if you're under the age of 65, you had roughly $12,000, and now you're doubled it to 24.4. It would have been 12.2 and now 24.4. So you would have to have a lot more charitable contributions, and if as you're getting closer to that 65, possibly over the age of 65, most individuals don't have very large mortgage interest any longer. So your mortgage interest is pretty much a small percentage if you have any. So charity, property taxes, and medical will be the major areas in which you're working with to try to meet this standard deduction. Also, you've eliminated the personal exemption. So for many people, if you have a large number of people in your household, maybe you have your parents, possibly that live with you, or grown children or younger children or grandchildren, whatever, that number has changed a lot in the situation of what you wanted to do. So you really have to rethink about how all that's going to work, is all it comes down to. Instead of the $4,050, you're now getting about $500 credit for or per an individual in your household, so it's not quite as much. So how can we make this work for us is the trick, because we've always had, in many cases, as you get older, people have had a harder time itemizing. And to be honest with you, you don't want to just itemize to itemize, meaning you don't want to just go spend a lot of money, take a huge mortgage and pay interest just so you can say you're itemizing, because keep in mind, whatever you itemize, you are really only getting a percentage of what your taxable income. So if you itemize $10,000 and you're in the 12% tax bracket, you're really only saving $1,200. So I had to spend 10 to save 1,200. Math doesn't work for us, right? So really what you want to do is look at mainly your charitable and medical. Medical cannot always be controlled, but we do what's called bunching, or even odds, what I've always referred to it. And we've had clients doing this for a number of years. So what we want to do is we want to take first your medical. If you're an older individual and maybe you have extended care, maybe you have a person that is coming into the house and helping take care of you, and maybe you don't have long-term insurance that helps with that, the cost of it, so you have quite a bit of out-of-pocket cost. You might be able to meet it, but keep in mind in 2019 it is 10% of your adjusted gross income. So if your income is $100,000, the first $10,000 is not going to show up. So it's everything above the $10,000 that will start working for the itemizing. Then you have your property taxes, and in the state we have sales tax. So those two things you're going to have. And that's going to maximize at $10,000. So we try to do is, in Tennessee, we receive our tax bills in October. I've received mine, in fact, in October, and we have until February to pay them. So what I usually do is I pay one in October of the year, and then I would pay the other one in the same year in January. So theoretically, January for the prior year and then October for the next year, all in the even year. I double up on my property taxes, so that way now I've met the $10,000 in my world. I've met the $10,000. I can't go any further than that. Then I have my charity. Charity is what you can control. So let's say that you usually give, I don't know, $12,000, $15,000 a year, but under the standard deduction now, or itemized deduction, you have to have more than 24 or even 27. What if you did it every other year? You took the $15,000 and you give it 1 year, and then you also paid the amount again in December. So you physically paid $30,000 ahead for the next year. So now I've got $10,000 in taxes, my double property taxes, and I've got $30,000 in my charitable contributions. Give me $40,000 this year. The next year I'm going to take the standard deduction. I'm entitled to the standard deduction anyways. So that's the way we can work the math out, but it does take a little organizing.
Yeah, so bunching is a great strategy. We, as Friday said, use it with clients for years as a way to, every other year, you're going to be able to itemize, and you get, as she said, then you get your standard deduction. So this is a way that over time, each of those odd years, you're picking up some deductions and ability to deduct that you couldn't otherwise. So if you're not, this is one of those areas, if you, talk to your advisor about that, your tax person, and say, hey, would I benefit from this? And if if you don't have someone to help you with that kind of thing, then I would call my office and we'll get you together with Friday. We can arrange a meeting in my office with her to go over your taxes and talk to you about your overall good financial plan that goes with a good tax plan. I mean, these are hand in hand and very important. A good comprehensive plan, tax strategies are an important part of that. All right, we're going to take a break. When we come back, we're going to dive back in and talk to you more about strategies, not just how these, what the laws are, not just giving you the details about the law, but how you can use that with these great strategies for reducing taxes, keeping more of your money in your pocket. That's the important part, and that's what's going to be, we're going to do for you here today. So keep pen and paper handy for these notes and stuff. And again, when we come back, I'll also give you another opportunity as far as getting in to get your own taxes done, a little end of year tax planning if you like. All right, first a quick break. Join us here. We'll be right back on the Retirement Report.
Storm 5 weather update. For weather on the go, download the Storm Shield app.
Happy Friday, November 1. I'm meteorologist Leland Statham. The coldest air of the season in place, and that allowed for a frosty morning. Wall-to-wall sunshine today, so let's check out temps from around the area. Highs this afternoon will run about 15 degrees below the norm for us for November 1, which is around 66 degrees. Here's what's happening right now in Nashville, along with the sunrise and sunset times. Remember now, going into the weekend, that's going to change. Daylight saving time will come to an end. 2 a.m. Sunday morning. Change the clocks and check the batteries in your smoke detectors. Here's a look at the forecast for you today. Upper 40s and low 50s this afternoon. Winds on the light side. 7-day forecast showing mid-50s for the weekend. We'll get back into the 60s next week. Have a happy weekend, everybody.
Time has come to enjoy your golden years, but have you saved enough?
I'm Hank Parrott. Don't just survive in retirement, thrive. Call me today at Estate and Financial Strategies or tune in for the Retirement Report each and every weekend on News Channel 5+.
You've been smart and saved for your retirement years. But now what?
It can be an overwhelming puzzle to see the big picture, but it doesn't have to be. I'm Hank Parrott of Estate and Financial Strategies, and I can help you thrive in retirement, not just survive.
Estate and Financial Strategies can help you maximize your wealth while minimizing your risks. Here's what we mean. To thrive in retirement, you need to maximize your Social Security benefits and your returns on investment and minimize taxes and the effects of inflation while planning for health care costs and increases in the cost of living.
Yes, you can thrive in retirement and not just survive, but you have to take that first step. Be one of the first 10 callers to my office to receive a comprehensive financial plan at no charge. This is more than just a free consultation. It's a full, comprehensive financial plan. Believe me, you can thrive in retirement. Don't just hope to survive. Do you know the difference between investing and speculating? Here is money tip number 83. Don't chase returns unless you want to see your dollars dwindle. Chasing high returns, taking unnecessary risk, and speculating as opposed to investing, all surefire ways to watch your retirement dollars dwindle. There's a science to investing based on 60 years of Nobel Prize-winning academic research. Investing is getting a market return with the least amount of risk. Want to know more? Check out the Retirement Report on News Channel 5+.
I called Ponce Law because I wanted to find out what my rights were. I am tickled to death with the result. They did everything they told me they'd do.
News Channel 5 this morning, winner of the Emmy for Best Morning Newscast.
Good morning and welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend, special guest, Dr. Friday with Dr. Friday's tax and financial firm in Brentwood, Tennessee. All right, we hit our first strategy, which was on bunching. Now we're going to talk about, again, if you want to, one of the things when it comes to planning for retirement is thinking in terms of tax efficiency. It's so important. We talk about all the time, it's not just what you make, it's what you keep. And keeping more of your money, one of the ways to do that is pay only the amount of tax that you're legally required to pay, not to pay excess tax simply by not knowing how these tax laws work. So an example was this bunching thing, okay? So think of that. There's a strategy. The rules are the same for everyone. Someone that doesn't employ that strategy is just going to pay more tax. right? You're going to just be paying more tax every year. The IRS isn't going to give you a phone call or send you an email or send you a letter saying, hey, there's this thing called bunching that you can do, right?
Exactly.
Their job is to collect as much tax as they possibly can. Now, if there's an error on your return, good or bad, I will say they will correct that whichever way it goes, okay? Unfortunately, usually it's the bad part. All right, but when it comes to saving as far as strategies, that's not their job. If you called them and say, hey, can you help me reduce my taxes? Not their job. They're going to tell you, we're not here for that. All right, so here's where this kind of, and I'll tell you another thing, they could get into trouble even if they were so inclined to try to do that, because that's not, they're not trained to do it, is the other part, and there are certain legal liabilities if they gave you bad advice. So they just stick to their knitting, which is collecting as much tax as possible. If you call and ask them what the deduction is, they might could tell you that. All right, here's the thing. Strategies like this are important for you to understand to keep more of your money. That one strategy alone could be worth thousands, tens of thousands of dollars to you, maybe even more than that if you think about it over your lifetime. Right. Okay? So here's another. We're going to talk about some of the differences when it comes. We were talking about with that, as I said, bunching means like your charitable deductions, you're paying your property taxes, doubling up on those in that 1 year. Another part of that is how, with the tax law, is how these have changed. So how, as far as your property taxes and your what's the other one? Local taxes, sales taxes, and that. How these limits have been put on these. Before we jump into that, again, if you would like to have some of the, us to look at your specific situation to help you with some of the strategies we're going to be sharing today and others that we probably won't have time to get to, I'm sure, because there's so many. Then just call my office. The number is 615-376-5325. We've got people standing by. They'll get your information. They'll send you out a checklist of things to bring to your appointment with me. And when you come in to see me, we're going to do a complete comprehensive plan for you. So that's why we're going to have you bring documentation to help with that. An investment analysis. Bring your brokerage statements and we can give you an investment analysis of your current investment plan. We'll show you Morningstar reports. We'll dive deep into the kind of mutual funds you have and what are in those mutual funds. Talk to you about the difference between active management and index strategies and how important that is to you, not only as far as taxes, because indexing is much more tax efficient than active management, but also as far as performance and reducing risk. Indexing, again, is going to be superior to active management over that. And I say this because there's so much research that's been done to prove that point. All right, and we'll share with you this knowledge and again, show you in your own. Imagine this, if I could show you your financial future based on things you're doing, if I can show you, for instance, in your current portfolio, there is a measure, it's called standard deviation, and we tie that to the market. So it'll show based on the market standard deviation, we can look at yours and see in the next bear market how your portfolio would hold up. Will it drop as much as the market does? Will it drop even more? We can show that to you and basically quantify this for you so you can see the type of risk you're carrying, and then at least you're making more educated, informed decisions as far as your planning goes. And that's a big part of the planning. I can show you your financial future based on the things you're doing and then share strategies with you to improve that future, to make sure you're going to have that lifestyle that you desire, to be able to thrive in retirement, not just survive, not just get by. We want to have fun. We want to enjoy it, right?
That's right.
All right, so let's talk about the difference now with the new tax law with regard to housing.
So with housing?
Yeah, with
SALT?
SALT.
Okay,
yes.
SALT. So bottom line is under SALT, basically that is your state income tax. In some cases, alternative tax, property taxes, those are what makes up SALT. So in our case, we have a sales tax instead of state income tax, and we have a property tax. We don't have a personality tax here. Some states do, California being one. But so when sometimes people will put their auto registration, that isn't qualified in Tennessee because we don't actually have a state income tax, therefore you're not deducting something. But just so you know, so you have your property taxes and your sales tax. Sales tax can be interesting. A lot of times, and this has been proven in my office, you can do it yourself. But if you physically, you have a choice. You can take what the IRS calculates based on your income and a calculation of percentage, how much sales tax would be used. The alternative is to track real sales tax. Some people actually have like credit cards they put most of their things on, or they save all their receipts. And I have physically had boxes of receipts come to my office and show me, these are all them Friday. I'm like, okay, what's the total? Yeah. And almost always they're thousands of dollars more than what the IRS showed for the percentage. So it may be something you consider, especially if you're relatively close when it comes to the itemizing. Remember though, when these taxes under the new law, before this, if you were, I have clients in other states, California, for example, I use this one a lot. My brother, his wife and him, they have a state income tax of almost $30,000. They have property taxes of another $5,000. They can only claim 10 of that $35,000. Yeah. No matter how much they paid in, 10 is all they're going to get. So just keep in mind, nice to live in a state with no state income tax. I say no state, but we do have the Halls.
We do have Halls income tax.
It's not an income tax, but we do have a tax here.
This is one of the areas too, and it's fading away. It will go away, but one of the areas here in Tennessee, then you may not have to worry as much as far as that limitation goes. It may not affect us here as it might in other states, as like Friday said. But here's something to consider as well. I know many of my clients have property in more than one state. Absolutely. So now we have, if you're combining these, this limitation can be harmful.
It could be. And again, for myself, even because I do that even out or the bunching that we were talking about, and mine would always exceed 10,000 in the past. Now I'm locked in, so I'm not getting quite as much as I used to between my sales tax and my 2 property taxes that I used to get.
Well, you got property taxes, and then how about mortgage interest? How does that work?
That mortgage interest, no limitations. That is in there, but keep in mind, if you purchased a home after January of 2018, a new mortgage, you could only use up to $750,000, and that includes your first and second home if you are using a first and second home mortgage situation. Used to be $1 million, now it's $750,000. So that is also some limitations to some individuals that you'll have to be careful with. And if you used a line of credit, a lot of people for many years would get a line of credit, go pay off credit cards, go buy a house, pay off the student loans, whatever, and use the interest on that line of credit on their thing. That is not allowed any longer. Lines of credit are allowed if it was used to buy the home you're living in, first or second, if it's tied to the home. If you used it to pay off other debts, it is not a tax deduction any longer. I don't know if you remember, Hank, about 10, 15 years ago, we used to be able to write off credit card interest. In the day, and so I think people found a way around that, right? So they would get mortgage interest because that was the way, and now the IRS has said, wait a second, we eliminated this once, now we're going to have to eliminate it again because most people are using lines of credit for other than their primary home reconstruction improvements.
This is an important point because I think, I know I have people come in and still are thinking, I'll do this home equity line. And then I'll be able to, pay off all this, pay off some
higher interest
notes
debt
and stuff and
consolidate
and be able to deduct the interest. So that no longer applies. In addition, when it comes to your mortgage interest, the same thing. They're not, unlike property taxes, which is saying 10,000 cap, they're not putting a cap, but they're capping how much of a mortgage you could have. And again, think in terms of potential multiple properties, how that might work. Now, on the tax part, is like Fry was just saying, the HELOC, you can't do it, a home equity line. Now, if you refinance your home,
take cash out.
Now you can, potentially
but then you're locked into the
$750,000
for multiple homes. So it is a problem, and
goes back to the strategy. This is so important to understand these rules. You can see how you could unknowingly go out and get a HELOC, pay off all these loans, thinking you're going to have write-off, and there's no write-off. Where you could have refinanced, maybe you want to compare costs. Of the financing, because refinancing typically is going to cost a bit more potentially than a HELOC might cost, but are the tax savings going to be worth it, and is it going to accomplish those goals?
And I think you end up with an 80-20 used to be, so you're going to usually take 80% with a refi and cash out, even maybe less depending on your credit. And so that's why the HELOC was nice, because they would give you that extra 20 in a short-term period. So yeah, you'd have to definitely talk to a mortgage person to get those numbers.
And it gets into the financing too. We're gonna take a break, but want to come back. One of the things we're going to talk about with all these strategies, as important as this is as much as it can benefit you, you have to look at the financial picture first. Then the tax piece is like the icing on the cake.
Yeah.
All right, because if it's a bad financial decision,
Then don't do it.
Tax savings isn't going to necessarily make it a good one, okay? And we'll give you some examples of that when we come back, and some things for your own situation, hopefully, to help you with that as well. So join us here. We'll be right back on the Retirement Report.
Just come to